To level up your life, you need business promoting, cash flowing, money momentum building, leverage. One key tool for this, believe it or not, is the policy loan. Now, policy loans are really cool because they're unlike any other loan that you and I are familiar with. There's no credit check, relatively expedited processing of a loan request. Best part, your cash value keeps compounding and growing and providing benefits to you inside of your properly designed contract, all creating money momentum. Today, Pro Client Guide coach Jason Herring, our IUL virtuoso, is going to talk about policy loans inside of an IUL and also touch on some infinite banking ideas inside of this example. Let's jump in. Jason, take it away.
Hey, thanks, Steve. Hello, everyone. Jason Herring here, your infinite banking and IUL specialist here at Insurance and Estates. Hope you're having a great day. So today, guys, let's talk a little bit more about the different types of loans that are available inside of an Index Universal Life contract. So I get a lot of questions here about when it is time to start taking, tax-free retirement income or doing some type of a loan from an Index Universal Life policy. How does the loan process work, right? How do you actually access the cash inside of the policy? And when you do take loans from the policy, what type of loan should I choose? Should it be an index loan or a standard loan? So these are a lot of common questions that we get. And the real answer is it really depends on what your goals and what your risk tolerance is, or how you really see the policy working for you. At least from an illustration standpoint, there's not a big difference between taking standard loans and index loans inside the illustration, which I will show you today. But I think this exercise will help you to kind of better understand your different loan options that you have inside of an IUL contract. So the best way to do that is we're just going to look at a case study. This is what we have here. We have a 40-year-old male that came to us within the past year. They were looking to do $25,000 a year of premium for 15 years and then allow the contract just to continue to grow so that they could take income basically from ages 66 through 85. So we have 15 years of premium coming in, and we're going to have about 20 years of income going out. So, of course, we designed this contract based off of a $25,000 annual premium. We designed it with the lowest death benefit that we could possibly use, and this still can be considered life insurance. So based off of this, the client was needing to purchase about $506,000 of death benefit in order for this contract to work. So what we're going to do first is we're going to look first at what standard loans would look like, okay? So as you can see here, we have 15 years of premium coming in. So we have a total outlay into the policy of $375,000. So once those 15 years of premiums are made, we are there going to start taking income. So we drop down here to policy year 26 and age 66, and we have asked the software to solve for how much of an income can I take each year based off of a 6% rate of return and the policy not lapse or have any danger down the road. So obviously here we're taking loans from the policy without any desire to ever pay these loans back, and any loan value that's still left on the policy will come off of the final death benefit to basically cancel and secure the policy. So let's look at this client. This client is able, based on a 6% average rate of return for all years, is able to take a $78,780 loan. And you can see the 5, 10, 15, 20 years of loan income coming out. So for a standard loan, this client is able to take roughly right at $78,780 per year based off of that average 6% rate of return. So let's look at the index loan numbers and compare. So as you can see here, we still have a $25,000 premium. This client was still purchasing $506,000 of death benefit. We have the 15 years of $25,000 in premium. We're still allowing the policy to just continue to grow. And then based off of a 6% average rate of return, we begin to start taking loans from ages 66 through ages 85. So 20 years. And here we're looking at 20 years of 86,573. So look at the final numbers here. This client was able to produce over $1.7 million of income, okay, through these 20 years of loans based off of a total cost outlay into the contract of $375,000. So if you remember from the standard loan, we were at 78,780. The index loan, we're at 86,573. So you're probably looking at that figuring, okay, Jason, how did this work, right? What are the mechanics to producing, a little over $9,000 more of income with differences between standard and index loans? Well, in order to truly understand how those two things work, let's drop down into the illustration and let's look at how these two loan types work. And when you're deciding which loan type to take, how does this affect you and your policy? So for a standard loan is very simple. You're simply telling the insurance company that you want to take a standard loan and that whatever loan amount you take is basically going to be removed from the indexed accounts, and it's going to be set over to the side, and it's going to be guaranteed a certain amount of interest. So what you can see here is that the guaranteed minimum interest rate on all standard loans is 2%. This client was taking a standard loan after year 10. So the actual loan interest charge is 2% as well. So the client is getting 2% on his loan value. He's paying 2% in loans, and he has a complete loan wash there. So that is really how a standard loans works. Pretty simple way to figure out what your charges and what your crediting is going to be with a standard loan. Index loans have become extremely popular inside of IULs, and for very good reasons. The regulators have actually stepped in, and they have limited what insurance companies and what agents can do as far as illustrating large spreads between index loans and standard loans. So one of the key pieces here that you need to look at for an index loan, for the purposes of this illustration, interest credited on index loan values is assumed to be no more than a 0.5% above the index loan interest rate charged. What does that mean? So what that means here is that if this company is currently charging 5%, which is what you see here, then the illustration is basically saying that the crediting rate that you're receiving is 5.5%. In the old days of when index loans first came out, you could see clients or you could see agents sometimes, they would have a much larger spread than 0.5%, and it would make the numbers inside the policies sometimes look unreasonable. So I do like that our industry has come back and we've standardized what we can show in index loans. So basically, the difference that you're seeing between the 78,780 and the 86,573 is simply this additional 0.5% crediting that has given us this higher loan rate of 86,573. So when we're looking at index loans, all we're doing is we're keeping even the loan value inside of the indexed accounts. And the loan value is able to go after the high cap that's available inside of this chassis. So if the company is currently offering a 6%, or I'm sorry, a 10% cap, then even your loan value could be credited with that 10% cap. Now, keep in mind that if the index only, returns a 0% rate of return, then your indexed loan value would also return a 0% rate of return, and you would have a true 5% loan interest rate. So it's very important that you understand when you're looking at taking loans inside of an index universal life contract, that you understand the mechanics of this. But it's also very important to understand why you're seeing larger distributions available to you with an index loan versus what you're seeing with standard loans. Guys, this is why it is so important for you to work with people like us that have been working day in and day out with index universal life products now for over 14 years. We have the experience, we have the knowledge to walk you through all the different mechanics of this index universal life contract and make sure that you understand exactly what it is that you are adding to your overall portfolio.